I think you could see down 20, 25% in many of these names. But here's the names that I want to be buying onto that dip. I want to be buying Apple or adding to it. It's already a very large position for me because I do believe in the wearables growth end market. Amazon, we know about retail e-commerce, same deal. If that stock, I actually sold some of that stock about 50 points ago. So if that stock were to pull back, absolutely I would add. Salesforce, I think SaaS cloud and the total addressable market of $1 trillion by the end of the decade is the most compelling to me. And they just put up a monster quarter. And I know that stock rallied, but it's now given back 15%. So I do think that you have to keep an eye on some of these names. And to your point, if it broadens out to the bigger market, well, okay, maybe it does. And you know what? We've had a nice run from the lows. I would still advocate for a barbell approach. Secular growth, technology, cyclical. Cyclicals because the economy is gradually recovering, including jobs last week, which I thought at least it's on the right path of seeing improvement. Still a ways to go, but the economy, there are certain pockets in the economy that are seeing a V recovery, and I want to have cyclical exposure because of that. So barbell.
All right. So, John, which tech stocks, let's say if we have that whole basket of tech, which are the ones that are most at risk? Is it the FANGs, which had gains, as Steph was saying? Apple up 134% from the low, Microsoft 70%, Alphabet 85%, Amazon 63%, Facebook 104%. Are those the ones that are most at risk, or are we talking about the Shopifys and the Twilios and the Wayfairs and the Zscalers, the Cloudflares, ones that are really getting hit over the last few days or so, and the ones that were really up? We're talking 100, 200, 300%, if not more.
Yeah, the latter, Scott. Just as you said, it is, the Spotifys. It is the Zoom video. It is, and I have owned many of these stocks on that run up. And I think those stocks are much more likely to give it back and much less likely to see Stephanie Link or to see Sarat Satie stepping in there and buying those names. I think, just as Stephanie said, her own words, she's looking to buy some Apple and some of these others that did justify with their last earnings announcement, Scott. So the others, many of those others, those moves were a little too extreme. We never knew when it would end. And apparently, from some of these reports, it ends with this fizzle over at SoftBank, and I have lots to say about that, but I'll hold off and say
you don't
that
have to
I
hold
think
off.
it's...
You don't have to hold off on that because
okay.
I wanted to even ask you and go there. If we think that,
okay.
and I don't know how to quantify it, but if we think that a fairly substantial part, a meaningful part of the run-up was due to this call buying activity in SoftBank and then their counterparties having to buy the underlying stocks to hedge that risk, if we think that had a meaningful role to play in all of this and that unwinds, and to the degree it does, we just don't know, doesn't that suggest that you could have an air pocket going down to some degree?
And I think we saw that over the last couple of days. But, Scott, one of the key things when you were out last week, when this story first broke on Friday, I believe, was that people said it was SoftBank that was purchasing these particular derivatives, and they called it a gamma gambit. And indeed, that's what it would be. They're throwing a turbo onto those particular stocks. And notice, I didn't say Spotify, I didn't say Zscaler or any of those others. They had specific bets, allegedly, in Amazon, Microsoft, in most of the FANG names. So that boost provided, and as you say, many of those people had to hedge that exposure because they get shorter and shorter from selling those calls. They get shorter and shorter as the market runs up. So it's a similar sort of thing that we've seen from this trader that we call 50 Cent in the VIX. When you see that thing start to move, people need to actively, dynamically hedge, and they can't always do that. So what I would point out, Scott, is it could be those people that were doing the hedging that were probably having to buy stock aggressively to basically cover their exposure to those derivatives that they sold, some of which may have been over-the-counter derivatives. In fact, a lot of them could have been over-the-counter derivatives. When they're doing that, those could be the folks that were getting flushed to the downside, because you lose a lot faster on stocks to the downside than you do on options. Because obviously you buy a $2.50 option in Microsoft, for instance, 2 months ago, Scott, and that starts running to the upside, Microsoft does, and you have to keep hedging to protect yourself against that run. Well, when the thing turns around, like it did on Thursday last week dramatically, again Friday and today, the third day of this sell-off, many of the folks that are getting clocked could be those same people who are getting clocked on the way up, and they were scrambling to buy that protection. Many times in my career, I've seen exactly that play out, where those folks that then have to flush, have to sell those stocks as they're going down so quickly. That would seem to play out to more of what we're seeing right now, much more than that gamma gambit of buying upside calls and just doing it over and over and over again since March, which allegedly SoftBank had been doing literally on a weekly, if not monthly basis.